Chapter 1. The Market Before the Storm. Every market has two faces. One face is calm, almost polite, like a lake under a pale morning sky. Prices move in small steps, traders grow sleepy, and the crowd begins to believe that nothing important is happening. But the other face waits underneath. It is the storm face, the face of sudden expansion, when a quiet chart becomes a battlefield and a small candle becomes a declaration. Volatility breakout begins with a simple observation. Silence in markets is rarely empty. A narrow range can be a room full of people holding their breath. Buyers wait, sellers wait, algorithms wait, institutions wait, and somewhere behind the screen, capital is preparing to move. The strategy does not ask the market to explain itself. It watches the door, and when the door breaks open, it follows the force. This is why the idea feels older than trading terminals. Merchants in ancient ports understood that prices could sleep for weeks and then wake up violently after a storm, a war rumor, or a ship's arrival. Grain, spices, silver, oil, cotton, bonds, and stocks have all lived under the same law. Pressure builds quietly before it escapes loudly. Volatility breakout is the art of listening for that escape, but this art is not magic. It is not prophecy, and it is not a secret tunnel to easy money. It is a disciplined way of saying, when price leaves its cage with enough force, I will respect the movement, but I will also respect the risk. In that tension between courage and caution, the whole story begins. Chapter 2. The Old Road of Breakouts. Long before traders spoke about volatility breakout, they spoke about breakouts. A price made a new high and people noticed. A price broke below an old low and fear moved through the crowd like a cold wind. The earliest forms of technical trading were built around these visible borders because even before computers, humans understood territory. A market had walls, and when the walls failed, something important had changed. Richard Donchian became one of the great names attached to this old road. His channel idea was beautifully severe. Look at the highest high and the lowest low over a chosen period, and let those levels define the battlefield. No poetry was needed on the chart. If price escaped above the upper boundary, strength had spoken. If price fell below the lower boundary, weakness had spoken. It was almost medieval in its simplicity, a gate, a breach, a pursuit. The beauty of Donchian-style thinking is that it removes the need for personal drama. The trader does not need to feel brilliant, wounded, excited, or betrayed. The rule stands outside the ego. The market crosses the line, or it does not. In a world where people invent stories after every candle, that kind of objectivity is almost aristocratic. Volatility breakout later added a more sensitive ear to this old instrument. It was not enough that price crossed a line. The crossing had to carry energy. A lazy step beyond yesterday's level is different from a violent expansion after compression. The strategy began to ask not only, where is the price, but also, how hard is the market breathing? Chapter 3. Wells Wilder and the Measurement of Heat. In 1978, J. Wells Wilder gave traders a set of tools that still feel modern because they addressed a permanent problem. Markets are not smooth. They jump, gap, hesitate, and move in ways that simple formulas often fail to capture. Wilder's average true range, or ATR, became one of the great instruments for measuring market heat. It did not try to predict direction. It simply asked, how much is this thing moving? That distinction is crucial. Volatility is not the same as bullishness or bearishness. A storm can blow north or south, and a market can explode upward or downward. ATR became useful because it treated volatility as its own creature, separate from opinion. It gave traders a ruler for the size of the beast before they decided whether to ride it. For volatility breakout, ATR is like a lantern in a dark stable. It helps the trader see whether a breakout is large relative to the market's normal movement. A move of $1 may be dramatic in one stock and meaningless in another. A 10-point move may be thunder in a sleepy bond market and only a footstep in a wild cryptocurrency. ATR gives context, and context is what separates signal from noise. Wilder's legacy is not only technical, it is philosophical. He helped traders move from vague emotion toward structured observation. Instead of saying, the market feels active, they could say, the range has expanded beyond its recent norm. That is the moment when a romantic story becomes a tradable language. Chapter 4. The Opening Range, the First Hour as a Duel. Every trading day has an opening scene. Bells ring, Orders collide, overnight news is judged, and the market reveals its first emotional temperature. The opening range is the high and low created during the early part of the session, often the first few minutes or the first hour. To some traders, this range is not just data. It is the morning duel between buyers and sellers. Toby Crabbe became one of the central figures in the systematic study of opening range breakout. His work treated the open not as random noise, but as a compressed theater where information, fear, greed, and liquidity meet quickly. The old trading floor had a physical rhythm: bodies, voices, hand signals, paper, shouting, and sudden silence. In that environment, the open could feel like the first cannon shot of a campaign. The idea is simple enough to explain to a child and difficult enough to survive a professional desk. If price breaks above the early range, perhaps buyers have seized the field. If price breaks below it, perhaps sellers have taken command. But the real question is not only whether the line breaks. The question is whether the break has conviction, volume, volatility, and follow-through, or whether it is only a false trumpet in the fog. In everyday life, this is like watching the first minutes of a public debate. One speaker may begin softly, testing the room, then suddenly a sentence lands, the audience shifts, and the whole energy changes. The opening range captures that first contest of authority. Volatility breakout tries to recognize when the contest has become movement. Chapter 5. Larry Williams and the Romance of Range Expansion. Larry Williams helped popularize the idea that abnormal range expansion can mark the birth of a meaningful move. The concept has a rough frontier elegance. If the market moves far enough from a reference point, it may not be wandering. It may be escaping. The previous day's range, the opening price, or another volatility measure can become a yardstick. When price travels beyond that yardstick, the trader treats the move as a message. There is something very American in this logic. It feels like the language of railroads, cattle trails, commodity pits, and wide weather. Corn, soybeans, bonds, currencies, gold, and stock indexes all become landscapes where distance matters. The strategy does not ask whether the market is beautiful or morally correct. It asks whether the move is large enough to deserve attention. The romantic danger is obvious. Big movement attracts imagination. A trader sees a breakout and begins to dream of heroic profit, as if every candle were a horse running across the plains. But range expansion is not a guarantee. Sometimes the horse turns around. Sometimes the breakout is a trap, and the trader who chased glory is left standing in dust. That is why volatility breakout must be paired with discipline. The entry is only the first line of the story. The stop, the position size, the exit, and the refusal to overtrade are the rest of the plot. Without them, range expansion is only excitement with a chart attached. Chapter 6. The Turtles, a Bet on Discipline. In 1983, Richard Dennis and William Eckhart argued over one of the great questions in trading. Are traders born or can they be made? Dennis believed a rule-based method could be taught. Eckhart was more skeptical. Out of that disagreement came the famous turtle experiment, a story so perfect that it almost sounds invented by a novelist. A group of ordinary people would be trained to trade futures with rules, risk control, and breakout logic. The name turtles came from Dennis's reported comparison to raising turtles in Singapore. Whether one finds that charming or strange, the metaphor survived because it captured the experiment's boldness. These were not old Wall Street aristocrats born under mahogany ceilings. They were selected, trained, and handed a system. The market would test whether discipline could imitate genius. The turtle approach used trend-following breakout principles and volatility-based risk management. It did not try to predict tomorrow's newspaper. It waited for price to move beyond prior highs or lows, then entered with defined rules. The method accepted that many trades would fail. Its faith rested in the occasional large move, the rare migration of price that could pay for many small defeats. The deeper lesson of the turtles is not that one old rule should be copied blindly forever. Markets change, competition changes, execution changes, and edges decay. The lasting lesson is colder and more useful. A system is not only an entry signal, it is a complete moral code for behavior under pressure. Chapter 7. Compression, the quiet room before violence. A volatility breakout often begins with compression. The chart narrows, candles shrink, volume may fade, and price begins to look bored. Many people ignore these moments because they do not entertain the eye. But compression is one of the market's most theatrical states. It is the scene before the door opens, the silence before the verdict, the held breath before the orchestra strikes. Toby Crabell's studies of narrow range patterns belong to this world. A narrow range day suggests that neither side has yet won, but the energy of indecision may be accumulating. Like a spring pressed under a hand, the market can only remain compressed for so long. When the hand lifts, movement often arrives with surprising speed. The trader who studies compression is not bored by quietness. He is suspicious of it. This is connected to life outside markets. A family dinner can look calm until one sentence releases years of tension. A political system can appear stable until a small event reveals hidden pressure. A workplace can feel peaceful until one resignation exposes a structural problem. Volatility breakout is built on the idea that calm surfaces sometimes conceal unstable interiors. Still, compression alone is not enough. Many quiet markets remain quiet, and many narrow ranges produce nothing. The disciplined trader does not worship every silence. He waits for evidence that silence has become force. The signal is not the cage. The signal is the break from the cage. Chapter 8. False Breakouts, the Market's Practical Joke. Every breakout trader eventually meets the market's practical joke, the false breakout. Price crosses the line, confidence rises, the trader enters, and then the move collapses back into the old range. It feels personal, as if the chart looked directly at the trader and lied. But the market is not lying. It is simply revealing that a line can be crossed without a crowd following through. False breakouts happen because markets are social machines. Stops cluster beyond obvious levels. Short sellers may cover above highs, buyers may chase strength, and algorithms may probe liquidity. A brief move beyond a boundary can trigger orders without creating a true trend. The result is a flash of movement that looks like escape but behaves like a trap. This is where volatility breakout becomes more subtle than ordinary breakout trading. The trader asks whether the move has enough expansion, speed, range, and context to matter. A breakout from a sleepy range during dead liquidity is different from a breakout during an active session after meaningful news. The same shape on a chart can carry different meanings depending on the surrounding weather. The lesson is almost ethical. Do not fall in love too quickly. The market often rewards patience after the first signal and punishes emotional certainty. A false breakout teaches humility, and humility is not weakness in trading. It is armor. Chapter 9. Risk, the price of entering the story. The most dangerous part of a volatility breakout is not the entry. It is the imagination that follows the entry. Once a trader is in the position, the mind begins decorating the future. A small profit becomes a fantasy of escape. A small loss becomes an insult. The chart stops being a chart and becomes a mirror of pride. Risk management exists to prevent that transformation. Position size decides how much of the trader's life is allowed to enter the trade. Stops decide where the story must end if the market refuses the premise. Volatility-based sizing recognizes that a wild market deserves smaller exposure than a quiet one. This is not cowardice. It is engineering. The turtles understood this with unusual seriousness. Their system treated volatility as a basis for position sizing, because a market that moves violently can wound a large position quickly. The lesson applies beyond futures. A volatile stock, a crypto asset, or a leveraged ETF can move enough in minutes to destroy a careless plan. The more dramatic the instrument, the more disciplined the sizing must be. In romantic language, risk is the toll paid to cross the bridge. No trader enters the kingdom of movement for free. The wise trader pays a known toll. The foolish trader signs a blank contract and calls it bravery. Chapter 10. Black Monday in the Memory of Panic. On October 19, 1987, the market gave the modern world one of its harshest lessons in volatility. The Dow Jones Industrial Average fell 22.6% in a single day. It was not a normal decline. It was a historical rupture. Screens, phones, trading floors, institutions, and regulators all discovered that modern finance could still behave like a stampede. For volatility traders, Black Monday became part of the collective mythology. It showed that price can travel farther and faster than elegant models expect. Portfolio insurance, program trading, liquidity stress, and fear interacted in ways that made the decline feed on itself. The market did not walk down a staircase. It fell through the floor. The lesson is not that every breakout is a crash or every crash is tradable. The lesson is that volatility is not merely a number. It is human coordination under stress, and under stress, coordination can fail. Bids disappear, spreads widen, assumptions break, and the trader discovers whether his risk plan was real or decorative. Volatility breakout strategies seek movement, but they must never romanticize chaos. A storm may offer direction, but it also destroys ships. The trader's job is not to worship the storm. The job is to decide whether the vessel is strong enough to sail. Chapter 11, VIX, When Fear Received a Ticker. In 1993, SIBO introduced the original VIX, and fear received a kind of public instrument panel. The index was designed to measure the market's expectation of near-term volatility through options prices. This was a profound cultural moment. Volatility was no longer only something traders felt in their hands and stomachs. It became something quoted, watched, charted, discussed like weather. The VIX is often called a fear gauge, but that phrase is both useful and incomplete. It measures implied volatility, not fear itself. Still, markets are human enough that fear leaves fingerprints in option prices. When investors rush to protect themselves, when uncertainty grows, when the future feels less stable, implied volatility can rise. The market's nervous system becomes visible. For a volatility breakout storyteller, the VIX is a powerful character. It is the barometer in the captain's cabin. It does not tell you exactly where lightning will strike, but it tells you the air has changed. A low volatility environment may feel peaceful, but peace can become complacency. A high volatility environment may feel terrifying, but terror can also mark opportunity for those who respect risk. In the present, volatility is everywhere. Equities, crypto, commodities, currencies, rates, and even narratives themselves. News travels faster than old traders could have imagined. A central bank sentence, a court decision, an earnings surprise, or a geopolitical headline can move billions before ordinary people finish reading the headline. The VIX era taught markets to watch their own heartbeat. Chapter 12, LTCM and the Danger of Elegant Certainty. In 1998, long-term capital management became a warning carved into financial history. The firm was filled with extraordinary intelligence and built around sophisticated relative value strategies. Its people understood mathematics, bonds, spreads, leverage, and theory at a level far beyond the ordinary trader. And yet, when markets moved against them and liquidity vanished, elegance became fragile. LTCM was not a volatility breakout story in the simple sense. It was not a Donchian channel or an opening range system. But it belongs in the same universe because it teaches what happens when models underestimate extreme movement. The market can remain irrational, stressed, or illiquid longer than a beautifully reasoned position can survive. Volatility does not care how prestigious the equation looks. The rescue organized among major banks, with the New York Fed facilitating discussions, showed that one firm's risk can become the system's risk. In calm times, positions may look isolated. In crisis, everything becomes connected. Spreads widen together, liquidity vanishes together, and the exits become too small for everyone trying to leave at once. For a volatility breakout trader, LTCM is a dark mirror. It says, never confuse intelligence with invulnerability. A simple rule with honest risk control may survive better than a brilliant theory with hidden leverage. The market respects no diploma, no Nobel Prize, no reputation, and no beautiful back test when the storm arrives. Chapter 13, The Modern Battlefield, Algorithms, Speed, and Fragmented Liquidity. Today's market is not the pit market of old photographs. The shouting floor has become a lattice of servers, exchanges, dark pools, routers, and automated strategies. Orders travel at speeds that would have seemed supernatural to earlier traders. Liquidity appears, disappears, and reappears like a ghost. The breakout trader still watches lines, but the battlefield underneath those lines has changed. This does not mean volatility breakout is dead. It means the old idea now lives in a more competitive ecology. Obvious levels attract more attention. False breakouts may happen faster. Execution quality matters more. Slippage, spread, fees, latency, session structure, and market selection can decide whether a theoretically good idea survives contact with reality. Crypto added another chapter to this evolution. Unlike traditional markets, many crypto markets trade continuously. without a clean daily open or close. Volatility does not wait for a bell. It moves through weekends, Asian sessions, European mornings, American afternoons, and sudden online rumors. The trader who imports old rules into new markets without adaptation may discover that the map no longer matches the terrain. Still, the ancient rhythm remains. Compression still precedes expansion. Crowds still gather around obvious levels. Fear and greed still accelerate when price escapes a range. The tools have changed, but the nervous system has not. Volatility breakout survives because markets remain human even when machines carry the orders. Chapter 14. Building the strategy as a story. A volatility breakout system can be built like a story with 5 acts. First comes exposition, define the market, time frame, and normal volatility. Second comes development, identify compression, range, or reference levels. Third comes the inciting event. Price breaks beyond the threshold with enough movement to matter. Fourth comes conflict. The position must survive noise, pullbacks, and doubt. Fifth comes resolution. Exit by stop, target, trailing rule, time rule, or reversal. This structure helps because it prevents random trading. Many beginners enter because something looks strong. That is not a strategy, it is a mood. A real volatility breakout model must define its world before the candle arrives. What is the reference range? What counts as expansion? What invalidates the trade? How much can be lost if the market refuses the story? The trader should also decide which personality the system has. Is it an intraday opening range system, hunting early session movement? Is it a swing system, waiting for multi-day compression to break? Is it a trend-following system, using Donchian-style channels and volatility-based sizing? Each version has a different rhythm, like different forms of music. A waltz should not be danced like a war march. The best strategies are not only profitable in a spreadsheet, they are psychologically survivable. A trader must be able to execute the system on boring days, losing days, and days when social media screams the opposite opinion. The system must be clear enough to obey when the trader is tired. That is where craft becomes character. Chapter 15. The Everyday Metaphor. Why People Understand Breakouts. Volatility breakout is easy to understand because life is full of breakouts. A quiet student suddenly raises his voice in class and everyone turns. A company trades sideways for years, then releases a product that changes its destiny. A person tolerates a bad job until one final meeting breaks the range and resignation becomes inevitable. Movement after compression is not only a market pattern, it is a human pattern. This is why the strategy lends itself to romantic language. It is about pressure, borders, release, and consequence. It is about the moment when the invisible becomes visible. Before the breakout, everyone has theories. After the breakout, the market has made a statement. The trader's job is not to argue with the statement, but to decide whether it is strong enough to follow. Yet the best ending is not triumphal. The mature trader does not say, "I have found the secret." He says, "I have found a lens." Through this lens, he can see how markets move from sleep to action, from balance to imbalance, from hesitation to momentum. The lens does not remove uncertainty. It gives uncertainty a shape. Volatility breakout is therefore not merely a strategy. It is a philosophy of thresholds. It teaches that quietness matters, that force must be measured, that courage without risk control is vanity, and that the market's most important moments often begin in boredom. The storm is dramatic, but the real professional studies the clouds before the storm arrives.